I think it is clear to believe in the power of ideas.
Fresh thinking to the Manhattan Institute.
Good afternoon. I'm Larry Mohn, president of the Manhattan Institute. Thank you for braving the snow to join us for what I'm sure will be a lively and enlightening discussion with Richard Fisher, the president of the Federal Reserve Bank of Dallas. Today's event is the product of a new partnership that the Manhattan Institute has formed with the economic policy think tank E21. For those of you who may not be familiar with their work, E21 is a Washington, D.C. based think tank directed by former George W. Bush presidential advisor Pete Wehner that provides timely analysis on economic issues and the fiscal challenges facing the nation. They are relatively new on the scene, but they've already made quite a name for themselves both inside and outside the Beltway. By adding E21 to our current lineup of policy centers, the Manhattan Institute gains an increased presence in our nation's capital and gives E21 an ongoing platform here in New York. We look forward to a long and fruitful partnership. My job today, however, is to offer a short introduction for the Institute's longtime friend and supporter, David Malpass. As many of you know, David is a nationally renowned economist, a former senior State and Treasury Department official during the Reagan and Bush 41 administrations, and most recently a candidate for the U.S. Senate. In Washington, David served first as a senior economist at the Senate Budget Committee and had a hand in legislation ranging from the 1986 tax cuts to the Roth IRA and the Gramm-Rudman Budget Act. He then went on to serve as Deputy Assistant Secretary of Treasury under President Ronald Reagan and Deputy Assistant Secretary of State under George H.W. Bush, where he helped to negotiate several trade agreements, including NAFTA. He spent the next 15 years at Bear Stearns and was repeatedly ranked by Institutional Investor as one of Wall Street's top economists. Today, David runs Encima Global, an economic research and consulting firm, and frequently shares his thoughts on economic matters on CNBC and in the pages of the Wall Street Journal and other prestigious publications. He also recently founded GrowPAC, a political organization dedicated to renewing America's commitment to smaller government, individual freedom, private sector growth, and strong national security. Please join me in welcoming David Malpass.
Thank you very, very much, Larry. If you thought that was good, wait until you see our speaker. Richard Fisher has an outstanding background. It's a great pleasure to have everyone here on a hearty, snow-filled New York day. And you're in for a real treat, a hearty speech by Richard Fisher, who has been around the world. He was born in LA, raised in Mexico, has Texas roots, and in 1974 was involved in the New York debt crisis as we failed. He was with Brown Brothers Harriman, knows Jerry Gold, who's one of Manhattan Institute's dear friends, and then went on to 21 years in the private sector, actually managing money, doing things that business people do and that New York is so very self-interested in doing. He's the only member of the FOMC that has extensive market experience, which makes him a huge asset to the FOMC and to us today to have as a speaker. In 1997, he became the Deputy U.S. Trade Representative, which is a very important global job, putting his fingers in lots of the trade agreements that were going on. Then he was with Kissinger Associates, and so what we have is a huge, thoughtful person with the breadth of experience that we can use to understand what's going on with our super complicated world today. So it's a deep pleasure to welcome Richard Fisher to Manhattan Institute and Economic 21. Thanks.
The only thing that was left out, David, in the introduction of you is you're the tallest economist, I think, in the world. And I'm delighted to be here. I've got quite a few friends here. You mentioned Jerry Gold, and we've been friends forever, and Guy Sorman, who Remind me today we've been friends for 40 years. He's much younger than I am, of course. I am thrilled to be here. Thank you very much for having me here. I love being in the hallowed halls of the Harvard Club. I've been a member of this club for over 35 years. I love its sturdy facilities, particularly the old building. I love its histories, the mounts they have from Teddy Roosevelt's African expedition of 1909 to 1910, which is beautifully documented in Edmund Morris's current volume on Roosevelt. And I will admit, I love its mustiness. But the thing I prize most about this facility is that the rooms here are cheap. And I'm not talking about the dining rooms, no comment about you or your co-hosts at E21. Last night I stayed in what used to be called the dorm room, one of those little rooms that's smack in the middle of the old building next door. These rooms are very sparsely furnished. They have only a sink and a bed and the smallest imaginable armoire. By the way, they measure 130 square feet. We check every fact at the Federal Reserve. I like them not only because they're better priced than any other rooms in New York City. I like them because they're stone quiet, and they're the only hotel rooms I know of in the city where the occupants cannot hear the grinding noise of trash trucks when the trash is collected. So I am especially honored to be here at the Manhattan Institute. I thank E21 for sponsoring this speech today, and I want to thank David for his kind introduction. You're busy. You've taken time out of your schedule. I'm very grateful. The Manhattan Institute and E21 are powerful proponents of the free market capitalism that made our country the richest and most successful democracy in the history of humankind. I take note of the Institute's claim on its website that it sponsors thinking, quote, literally and figuratively outside the Beltway, end of quote. Now that's a good thing. The Federal Reserve is structured to balance inside the Beltway influences with outside the Beltway thinking. The governors of the Fed in Washington, D.C. are appointed by the President of the United States and confirmed by the Senate. The 12 bank presidents like me who operate the system in the field and also sit on the Federal Open Market Committee, what we call the FOMC, with the Fed governors, are not. Instead, we are selected by and serve at the pleasure of our boards of directors. Those directors are drawn from the citizenry of our districts. And in my case, the Dallas Fed serves 27 million people who live and populate 360,000 square miles of Texas, northern Louisiana, and southern New Mexico, and whose economic output of those 27 million people exceeds that of Australia and is almost equal to that of India. On the policy front, the job of Federal Reserve Bank presidents is to bring a Main Street perspective to the table. When I was asked by the Dallas Fed Board to become president of the bank almost 6 years ago, I first met then with Alan Greenspan, and I asked the chairman how I could best serve the system. His answer was crisp: just speak to the truth. And that was all he told me. So today I'm going to speak to the truth, David, as I see it. You know that I speak only for myself. I do not speak on behalf of any colleagues at the Federal Reserve. I only speak for me and for the Dallas Fed and not for anybody else in the system. And I suspect that that will immediately become clear. A week ago today, a new Congress was sworn in. New leadership took office in the lower house with the new speaker saying, quote, "The American people have humbled us. They've reminded us that everything is on loan from them," end of quote. The Senate retained its leadership, but underwent a sea change of composition. At the other end of Pennsylvania Avenue, the White House announced significant staff changes, among them bringing in a highly respected former administration colleague, actually from my days as a trade negotiator, to be the President's Chief of Staff. The new Congress and the new staff of the White House have their work cut out for them. You cannot overstate the gravity of their duty on the economic front. Over the years, their predecessors, Democrats and Republicans together, have dug a fiscal sinkhole so deep that left under repair, it will swallow up the economic future of our children, their children, and their children. So they must now engineer a way out of this frightful predicament without thwarting the nascent economic recovery. I have been outspoken about the limits of monetary policy as a salve for the nation's fiscal pathology. The Fed has done much, in my own words, it's always good to quote yourself, you don't get in trouble, has done much to provide what I call the bridge financing until the new Congress gets to work, restructuring the tax and regulatory initiatives American businesses need to confidently expand their payrolls and capital expenditures here at home. The Federal Reserve has held rates to nil. We've expanded our balance sheet to unprecedented levels. After much debate, which included strong concern expressed by one member with a formal vote and others like me who did not have voting rights in 2010, the FOMC collectively decided in November to temporarily undertake a program to purchase U.S. Treasury securities that, when added to the previous policy initiatives, roughly means we are purchasing the equivalent of all newly issued Treasury debt through June. By this action, we run the risk of being viewed as an accomplice to Congress's fiscal nonfeasance. To avoid that perception, we must vigilantly protect the integrity of our delicate franchise, the Federal Reserve. There are limits to what we can do on the monetary front to provide bridge financing to fiscal sanity. Last Friday, speaking in Germany, ECB President Jean-Claude Trichet said it best, quote, "Monetary policy responsibility cannot substitute for government irresponsibility," end of quote. The entire Federal Open Market Committee, whether they are hawks or doves in the perception of the public, knows the history and the ruinous fate that is meted out to countries whose central banks take to regularly monetizing their government's debt. Barring some unexpected shock to the economy or the financial system, I think we've reached our limit. I'd be very wary of further expanding our balance sheet. But here's the essential fact that I want to emphasize today and get you to think about. The Fed cannot monetize debt if debt is not being created by the Congress in the first place. Those lawmakers who advocate ending the Fed might better turn their considerable talents toward ending the fiscal debacle that has run for too long amok within their own house. The Fed does not create government debt. Fiscal authorities do. Deficits and unfunded liabilities of Medicare and Social Security are not created by the Federal Reserve. They're the legacy of those with their hands on the purse strings, the Congress working with the President of the United States. The Fed does not earmark tax money for pet projects in local communities that taxpayers themselves would never countenance. Only Congress does that. The Congress and administration played the dominant role in creating the regulatory environment that incentivizes or discourages job creation. A look within the United States makes clear the overriding influence of fiscal and regulatory policy. Here's a thought exercise for you. Monetary policy is uniform across the 50 United States. The base rate of interest paid on a business or a consumer loan or on a mortgage is just the same in Michigan and California and Ohio or here in New York as it is that paid in Texas. Yet there is a reason that Michigan and California each lost more than 600,000 jobs over the past decade, and Texas added more than 700,000 over the same period. There is a reason that the population of Ohio grew by only 183,000 residents over the past 10 years, while Texas grows by that many residents every 5.5 weeks. There is a reason that each passing census, the state of New York, has been losing congressional seats and Texas has been adding them. A reason that in the recent census, California failed to gain any, while Texas gained 4. And there is a reason, as reported in this morning's Wall Street Journal on page 4, that college graduates are leaving New York and Cleveland and Detroit and moving to Austin, Texas. There is a reason that Texas now houses more Fortune 500 companies than any other state. There is an underlying reason underlying the graph that I placed before you at your seats that charts the disparate employment growth that's taken place in the 12 Federal Reserve districts over the past 2 decades. Look at the top line and look at the bottom line. That reason has nothing to do with monetary policy. It has everything to do with the taxation and the fiscal and regulatory policies of the states. The cost of capital does not explain the economic performances differences between the states. The cost of doing business has everything to do with those differences. However well-meaning tax and regulatory initiatives in the laggard states may have been when they were conceived and levied, they have had unintended consequences that have led to economic underperformance and job destruction. Similarly, the key to correcting the underperformance of the American economy and American job creation does not rest with the Federal Reserve. It's in the hands of those who make fiscal and regulatory policy. The Fed has reduced the cost of business borrowing to the lowest in decades. It has seen to it that liquidity is widely available to banks and to businesses. It has kept the economy from deflating, and it has kept inflation under control. This has helped raise the economic tide. Recent data made clear that the risks of a double-dip recession and deflation have ebbed, and that economic growth and job creation are beginning to flow. Yet the ships of job-creating investment remain, for the most part, tied to the docks, or worse, are choosing to sail for foreign ports where tax and regulatory conditions are more favorable, very much in the same way that Ohioans and Michiganders and New Yorkers and Californian businesses and workers are navigating their way to Texas. I don't believe this has much to do with the Fed. None of my business contacts, large or small, private or public, are complaining about the cost of borrowing, the lack of liquidity, or the availability of capital. All of them express concern about taxes, about regulatory burdens, and the lack of understanding in Washington of what incentivizes private sector job creation. All of them are stymied by a Congress and an executive branch that have appeared to them to be unaware of, if not outright opposed to, what fires the entrepreneurial spirit that made this country great. Many have begun to feel that opportunities for earning a better and more secure return on investment are larger elsewhere than they are here at home. Perhaps because I live so far outside the Beltway, both literally and figuratively, among the Washington skeptical, independent-minded people of the 11th Federal Reserve District, I was not surprised by the outcome of the recent election. As I watched it unfold, I thought of one of the better books I had read in the summer of 1998 at the recommendation of a friend, a fellow named David McCullough, an eminent historian. It was titled Cod, a biography of a fish that changed the world. It's written by a man named Mark Kurlansky, a New Yorker, and was considered by the New York Public Library to be one of the 25 best books of the year. Buried in the middle of that remarkable little book is a wonderful description of the causes of the American Revolution. Kurlansky wrote, and I quote, "Massachusetts radicals sought an economic, not a social revolution. They were not thinking of the hungry masses. They were thinking of the right of every man to be middle class, to be an entrepreneur, to conduct commerce, and make money," end of quote. And then referring to John Adams and John Hancock and John Roe, everybody seemed to be named John in colonial New England in those days, he posited that the revolution, quote, was about political freedom. But in the minds of its most hardline revolutionaries, the New England radicals, the central expression of that freedom was the ability to make their own decisions about their own economy, end of quote. And he concluded, and I quote again, "All revolutions are to some degree about money." Reminding the reader, reflecting upon France's Revolution, the Comte de Mirabeau said, "In the last analysis, the people will judge the revolution by this fact alone. Are they better off? Do they have more work? And is that work better paid?" End of quote. Well, we now have a new, younger, and in the manner depicted by Kurlansky, more radical Congress, working alongside a president as they seek to craft policies more responsive to the message given to them by the American electorate. The new Congress was elected, in my opinion, to cast off the status quo of what many have come to feel is an excessive encroachment upon people's freedom to make their own decisions about the economy. To do so successfully, this new radical Congress and newly inspired president had better keep in mind the Comte de Mirabeau's analysis. The people of the United States will judge them, not by their rhetoric, not by their declarations or their proclamations or their statements of intent, but by whether their policies result in people who are better off, have more work, and are better paid. The leaders of our government cannot attempt to talk their way out of the problem like their predecessors did. They must fix the problem now. If they fail to do so, then the election, for all of its hoopla, will prove to have been nothing more than putting old rancid wine into new bottles. This is not an easy task. Theirs is not an easy task. We've all become used to the false comfort of having government coddle us, whether we are rich businesses receiving subsidies or poor citizens subsidized by government largesse. The election tapped into a foreboding sense that the comfort provided now exceeds its benefits, as manifest in looming mega deficits, deep if not unfathomable unfunded liabilities, egregious abuse of fiscal power as symbolized by earmarks, and other methods used by politicians to grease the skids of their own reelection. Tapping into that foreboding is the easy part to get elected. Talk of reform is cheap. Enacting reform is painful. A reader of Shakespeare might recall the dialogue between Glendower and Hotspur in Henry IV. Glendower claims, "I can call spirits from the vasty deep." And Hotspur says, "So can I. So can any man. But will they come when you do call them?" We shall see if the new Congress will prove worthy of the power the American people have loaned them, and together with the President actually draw the spirits of fiscal reform and sanity from the vasty deep to at long last implement meaningful fiscal and regulatory policy that incentivizes private sector job creation here at home while arresting the hemorrhaging of our Treasury. If they do, then more Americans will find more work and be better off and be better paid and freer to make their own decisions about the economy. If they don't, then woe to our children and to the American dream. Now, I'm tempted to end this cheery talk by saying, have a nice day, and walking off the stage. However, I'd hate to leave this podium with your thinking that I'm just one more sort of central bank curmudgeon. I am professionally programmed to worry, but I'm also a red-blooded American. I draw on the wisdom of a man named Marcus Nadler, one of the great minds of the Federal Reserve from a period when our economy endured an even more dire test. To counter the intellectual paralysis and down-in-the-mouth pessimism that gripped our country and the financial industry after the Great Depression, Nadler put forth 4 simple propositions. First, he said, you're right if you bet that the United States economy will continue to expand. Second, you're wrong if you bet it's going to stand still or collapse. Third, you're wrong if you bet that any one element in our society is going to ruin or wreck the country. And fourth, you're right if you bet that the leaders in business and labor and government are sane, reasonably well-informed, and decent people who can be counted on to find common ground among all their conflicting interests and work out a compromise solution to the big issues that confront them. Well, this became known as Old Doc Nadler's remedy, and for my part, it's spot on. Every one of us preoccupied with what ails us should keep it in mind. It may be the stuff of the wildest dreams to imagine getting ourselves out of our current nightmarish predicament. But I believe we can, and I believe we will. We're Americans. I believe deep in my soul that when put to the test, Americans rise to the occasion, no matter how great the challenge. We've done it time and time again, and we have no choice but to do it now. So, David, I think I've said enough, if not too much, and in the musty, time-honored tradition of central banks and central bankers, I will now happily do my best to avoid answering any questions you may have. Thank you.
was fabulous. That was very hard hitting, worth coming out in the snow, and thank you. So I have an economic question, and then I've got a political question. On the economic or monetary policy side, people worry about the importance of the Fed's role in buying bonds, because what happens if they stop? So I wonder if you would comment on the general availability of funds. In your reading of how this is working, is the Fed actually adding funds that are needed? And if so, what's going to happen when they stop buying bonds? Or if they're not adding funds, what are they doing? Thanks.
Well, I think everybody in this room knows, but I'll walk through it in the most simplistic terms. It helps me think this through. When we buy government bonds, and right now, as I said earlier, we're in the process of buying roughly $100 billion a month through June, say 100 to 105. And by the way, that's 85 a month from what is known as QE2, and then the remainder is the roll-off of the mortgage-backed securities, of which we had $1.25 trillion. As they're paid down, we had made a commitment to the public to replace them with Treasury purchases. So take the two together, David, and you've got roughly 100 a month. When we buy things, we pay for them. When we pay for things, we put money out into the system. When we buy them back, we take it out. So when you're zero bound, and I am on record for having been against cutting rates to zero, but that's not the case presently. I think there's a very heavy price to be paid for that in terms of savers and those that played by the rules and stuck to the game. But there we are. That was a balance part of the argument that was considered but not put into the final decision. And the real issue here is, to what extent do we continue this process? And I think the market, in my opinion, has already begun to discount a little bit the fact that this won't go on forever. And people do say, gee, the 10-year has backed up 85 basis points since you met in November. Frankly, I don't consider that all that bad. We have affected the market in a way that I think has distorted the yield curve. That's pretty clear. Anchored it at zero, flattened it out. It's now getting steeper. Part of it, to me, is the good news that people are sensing the economy is doing better. But I think also part of it is a discount, and I don't know what the weights are, of the fact that there is a realization in the marketplace, as I said in my speech, this is a process that will not go on forever. So now, implicit in your question is, are we crowding out private capital? I'd be hard-pressed to say that we were presently. Actually, when you look at it, even though the 10-year rate is backed up, spreads have narrowed, and if you look at the price of junk financing, we're pretty much, if not at historic lows, at the lowest in an awfully long time. So that's another aspect of this. We want to be careful that we don't crowd out private investment, and I don't know anybody on the committee that has that as their objective. Now, I've forgotten your second question.
No, I didn't ask it. I'm going to
Oh, good. I've forgotten you to ask me the second question.
I'm going to ask a kind of a political question and then turn to others, because there's plenty of interest and great remarks to go after. Congress's role, I want to turn to your comment on Congress standing up and the relationship between Congress and the Fed. There's been proposals out there from Congress that they audit the Fed, or that someone audit the Fed. There's been the proposal about reducing the dual mandate. And so right now the Fed has a mandate to both have price stability and full employment. So should there be a change in the mandate? And then third, might be some limitation by Congress onto the Fed not to bail out state government debt, for example. How do you feel? Should Congress do nothing with regard to the Fed this year? I'm putting you on the spot. Should they should they call for an audit of the Fed, or a reduction in the dual mandate?
Well, first, on your third question, which you didn't use in your summary here, we cannot and we will not buy municipal securities. End of question. The chairman said this the other day, and I fully, obviously, support. He's stating a fact. Secondly,
so no prohibition. Isn't there some uncertainty? People will think, well, if the Congress won't do it, the Fed will do it.
I think the chairman made it very clear it will not happen. I second his movement. In terms of the other two questions, let me take them. The question of the mandate. because we are being audited. The audit was put forward by a friend of y'all's, a senator from Vermont named Bernie Sanders, and we're undergoing that audit presently. And by the way, we undergo massive audits. The Dallas Fed, like all the Federal Reserve banks in the system, is constantly audited. And I don't doubt for a nanosecond we'll stand up to the integrity of an audit. The issue is, should an audit be politically motivated? And I think it's pretty clear where I would stand on that issue. If anybody questions our integrity, then we should answer their questions. I don't think any audit will find that we don't conduct ourselves with great integrity, and I'm very proud of that. With regard to the mandate, that's up to Congress to decide. It would not break my personal heart if we ended up with a single mandate. That is the inflation mandate. We are the only central bank in the world that has a dual mandate. The full employment mandate, I believe, and speaking for myself, is a bit of a slippery slope. It gets you into political issues. And now, having said that, I'm not sure current policy would be much different if we only had an inflation mandate presently. We, like all things in Texas, we do things differently. We do not look at the core rate of inflation. We look at it, but we don't weigh it or the top line rate as much as we do what we call the trim mean on the personal consumption expenditure. We look at every item in the market basket, and as a good analyst should do, we trim out the most volatile on a monthly basis. Doesn't matter what it is. And we take an underlying out of every item in the market. We have a wonderful man named Jim Dolmas, like a mushroom. We put him in the basement. We have him calculate through all this stuff. He writes a monthly letter. You're welcome to access it on the net. And the current 12-month rate of inflation is running at about 0.8% according to the trim mean. Now, we're watching very carefully to see these commodity costs and everything else that are involved, but this is what actually affects a true shopper. And I don't think policy would be much different now, David, than it is, even if we only had a single mandate. Yes, yes, sir. This distinguished gentleman in the middle. Or distinguished looking.
I agree with your point about the limits of monetary policy. So my question really relates, if you would comment on a fiscal policy issue. The notion of trying to increase the employment rate, what both parties seem to agree is that we should subsidize small businesses that create jobs. We should subsidize businesses with tax policy. And my question is, if there's a problem with demand, or if you don't, for example, if a company doesn't need another typewriter because they have all the typewriters or computers or what have you, by giving them a 10% credit or by giving them any kind of tax subsidy, is that a waste of money? Because if you don't have a need for something, you're not going to buy it. There's something, it's throwing money down a bottomless pit. Why shouldn't subsidies be limited only to individuals, not entities, because many small businesses are owned by rich people, rather than to entities or whether, I don't care if you're subsidizing housing and subsidizing real estate or subsidizing, if subsidies were only limited to poor people, we'd save a lot of money and it would get a bigger bang for the buck. I'd be interested in your reaction to that argument.
With all due respect, I suspect that was a statement disguised as a question.
Fair enough.
But, I'm not a fiscal authority. I was not elected by the American people. I don't represent you or the people in my area. It's up to them to figure it out. I would just ask the fiscal and regulatory authorities to think of one major goal. How do you incent the private sector to create business on a sustainable basis? And how do you enhance the freedom for them to do that on their own two legs? Beyond that, I don't believe it's my role. It's not what I'm paid for, to provide specific fiscal and regulatory advice. But something's holding us back. And again, there's lots of liquidity out there. The gas tank is full, or close to full, but the engine's not going forward. Why not? Something's wrong with the transmission mechanism. Fix it. Next question. Yes, sir.
Gene Epstein, economics editor of Barron's. What Fed funds policy would you have preferred? And I like your graph. My readers will ask me, why isn't Houston on the graph?
Because Houston is a satellite of Dallas. The Federal Reserve Bank in the 11th District is headquartered in Dallas. That's my entire Federal Reserve District. It includes branches in Houston, San Antonio, and El Paso. And it is the activity and job employment of what is now, as I said in my speech, a basis of 27 million people over 360,000 square acres that has an enormous amount of economic production. So those are the Federal Reserve banks. Those are the districts. And my district, yeah, so if you read the footnote, you'll get it. I'm sorry, what's your question?
What Fed funds rate would you have preferred?
Well, it's academic because that goes back in history. But where I became very uncomfortable was when we got below 3%. And the reason for that was because, to me, and this may take a moment, but allow me the moment, the way we were then conducting monetary policy was the old-fashioned way. We were titrating the Fed funds rate. To me, the assumption of the titration of the Fed funds rate, which is the rate that banks borrow from each other, which we make that market through the New York desk, was that the plumbing system through which the titration flowed was there. It had integrity. Well, it was pretty clear that it was broken. I use a very simple analogy when I think about my job. My job is to make sure that the garden of the American economy blooms to the degree that monetary policy plays a role. What is monetary policy's role? It's to make sure that enough water is there to make sure that garden is lush. If we are too tight, it turns brown and it dies. If we flood it with water, we kill it with inflation. So using that simple analogy, to me, the flow wasn't the problem. The problem was that there were leaks throughout the system. They were called Lehman Brothers and Bear Stearns and blah, 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 AIG, et cetera, over which we were not regulators. We had a shadow banking system that was out of repair, and we had a banking system that was in disrepair. So to me, it wasn't a matter back then of what the rate was. Now, in addition to that, running up to August of 2008, until the Lehman crisis, we had inflationary pressures building. We could see it in the trim mean, and you could see it even in the core data and the headline data. That process came to a grinding halt when someone took the steel rod of the financial crisis and jammed it into the spokes of the economy. What we were seeing up to that point was what was coming in the door was costing more, and our business had pricing power, shoving it out the door to their ultimate consumers of services and goods. When the crisis hit, the economy imploded. Final demand disappeared. And also the pressures coming in the door disappeared. Businesses, as a result of the inflationary pressures they were seeing up to that point, were driven to efficiency. They were cutting costs, and they were using globalization and cyberization to drive their businesses to great efficiency in order to contain their margins, because the cost of what was coming in, even though they had pricing power, wasn't as great going out the door. Then the system went into reverse. Final demand evaporated. They were driven to even greater cost efficiency to preserve their bottom lines. We're still there, by the way. That's why we've had enormous growth in profits. What's the biggest single cost, by the way, is labor. So you drove your labor to maximum productivity, used technology and so on, and outsourcing and globalization in this new world to drive down that major cost and all other costs of operating. We now have a very lean and efficient business sector, and I believe it's the most efficient business sector in the world. It now needs to be incented to go out and take risk. Again, money is widely available. Interest rates are nil, whether it's the Fed funds rate or moving up the yield curve. And there's an enormous amount of liquidity. Somebody referenced the over $1 trillion in free bank reserves, excess bank reserves we have. And we know that cash flow as a percentage of underlying market value for corporate America is the highest in our lifetimes, our professional lifetimes. So that's the point I'm trying to make here. And the point about the vote on the Fed funds rate is that was then, this is now we have to deal with where we are now. Yes, sir. Let's go into far back, I'm sorry. the not-so-distinguished looking gentleman who just raised his hand.
Hopefully, substance triumphs form. In any event, I have two related questions. The first one is, to what degree do you think U.S. and developed world inflation can remain under control in the face of accelerating inflation in the developing world? And the second question is, could you offer your view on the credence to be lent to the widely watched indicators of inflation, the CPI and PPI, which of course are produced by the Labor Department, and how you feel they will perform when, under different inflationary conditions than we currently experience?
Well, I think they're useful measures of inflation. Again, we take a different approach. We take a trim mean approach, but we use a market basket for the PCE, which is the personal consumption expenditure. If the inference of the question is, are those numbers distorted? I do not believe they are. I believe they're useful tools. The question is, what do the American people focus on, and how do we conduct policy so that we don't ignite any embers of inflationary behavior, and at the same time we don't allow deflation to take grip. Americans do, by the way, eat, and they also drive cars. And I'm fully aware of the fact that food prices are rising and that gasoline prices are rising. So these are things that we have to take into mind, but at the same time, it is our duty as central bankers not to be given to emotion, not to be given to political impetus, but to just do what's right for the American economy. And in terms of the longer-term issue of the kind of inflationary pressure that you are hearing reported in some emerging countries, or some that, like China, I think you can say have at least emerged to a certain degree. The real issue is, again, what comes in the front door and how much pricing power is there to take it out the back door at higher prices. I'm beginning to hear with some of my corporate contacts, particularly those that are in the food processing industry and other industries, that they are making attempts. And I think McDonald's has been very public in terms of what they're trying to do. If you just look at the price of lettuce and tomatoes and meat patties and so on, even wheat, there is an attempt to move prices upward. If you look in terms of those that use a great deal of jet fuel, there's some interest in using their price power, testing their pricing power. And I've also noticed amongst retailers that at least in the second and third and fourth quartiles, not the first or bottom quartile, the discounting is becoming less and less of a phenomenon. So here's the point. I am a proud hawk on inflation. I don't see inflationary pressures presently. I don't see them in the immediately foreseeable future. I and my colleagues, all of us, are on guard, and we know what a pernicious influence it can be. That's not the problem right now. The problem is getting the economy moving again, and the problem is getting the economy moving again. It creates American jobs. Very tough thing to do. I believe that responsibility is squarely in the hands right now, given what we've done, in the hands of those that make the laws and write the rules, and I hope they get it right. Yes.
Thank you for coming, by the way. Do you think, from a political standpoint, that the president and his administration can accommodate the vision you have of reviving America with a lower tax environment and less regulation? Do you think the administration can accommodate the new Congress if they do propose the kinds of things that you feel are necessary to revive our economy and create jobs?
I'm not going to comment on any one individual. I don't doubt the sincerity of any one of these actors. All I can say is that I hope a message has been received. A, there are limits to what a central bank can do. We know what the history is of those that just went along. We've heard about Weimar Germany and nationalist China, and the lights are going out in this room. So we know the consequences. I mean, all of us have been to Argentina, and we've all got our billion Zimbabwean dollar notes in our wallets and so on. Democrat or Republican, I don't think it matters. They both played this game too long. Let me give you a real life story, which I love, and it's not me, but I think it summarizes everything. When George Shultz was head of OMB, the Office of Management Budget. Now this is, I think there's nobody in modern times that has held more cabinet jobs than George, right? Secretary of Labor, Secretary of State, Secretary of the Treasury, et cetera, et cetera. A truly great public servant. Happens to be a Republican. President Nixon was in power. He was worried that they were running deficits of some minuscule portion compared to what we're doing now. And he called a man named Cohen into his office. Mr. Cohen was the encyclopedia of American budgetary history. And he said, let's assume his name was Sam. Sam, just between you and me, here we are in the middle of the night, is there really any difference between Republicans and Democrats when it comes to spending money? Now, Mr. Cohen was a devoted public servant. He was a precise man. And he said, Mr. Shultz, let me research this and I'll come back to you tomorrow morning. So next morning he shows up. This is according to George Shultz. And he says, there's only one difference. Democrats enjoy it more. I don't believe that's any more the case. I think Republicans and Democrats working together, as I said earlier, have dug a fiscal hole and of disincentives and debt that is so deep that both of them are to blame, and it's going to kill our children. And we have to do something about it. The real test is going to be this new, quote, radical Congress. They can say all the right things. What are they going to do? Where are they going to inflict the pain? And they're going to have to do so. I worry tremendously of the natural tendency of politicians to say to the central bank, and this has happened throughout history, going back to ancient Rome, they didn't have a central bank, but their equivalent, or if you read the new book on Cleopatra, you'll see some interesting aspects of monetary policy. Print our way out of it. We won't do that. We can't do that, and we should not do that. So it's time to fish or cut bait. There was a great little piece in one of the newspapers this morning, I'll quit with this, a newly elected member of the Texas legislature, a woman who's a rancher, never run for public office, got elected with Tea Party support, and first time she's ever been in government. And they talked about the Texas budget deficit, which is our biennium budget. She said, well, we were driving along, we fell asleep at the wheel, we drove into a ditch, and now we have to get ourselves out of that ditch. That's the job that they have to perform. Thank you for putting up with me. I appreciate it.
I think it is clear how fortunate we are to believe in the power of ideas.
Supply the common sense and the fresh thinking of the Manhattan Institute.